Welcome to a video that I call the deep dive video, and I need to explain this right off the bat. The name might be a little bit different than what you think by looking at the thumbnail. Every week I do a number of videos. I do a video each day, I do a video each week, and then I do an intermarket analysis video. The last video each week that I do, I go through all of the daily charts that I looked at and some additional charts that only apply to this particular video, and I put them together and present them here. What I like to do in the daily videos is just show charts that are really telling us something. Sometimes we're seeing something right now. Other times that can take place over a period of a number of days, and you can see that changing day by day. Well, other charts that aren't necessarily speaking really loudly right now, I don't include those in the video. But sometimes it can be to our benefit to go back and look at those charts because we can get some clues about what's going on in the market by looking at some of these other charts. And I've also found that since I started doing this video, it's been pretty popular. So I decided to go ahead and keep doing it. This is being prepared for Tuesday, January 2nd, and Happy New Year. The first chart that you look at does have the VIX on this chart, and you may hear some background explosions because of the new year. I can't really control that, so I just kind of have to keep going no matter what happens. But this is a chart of the VIX, and that measures fear. And when the VIX is going down, that means there's not a lot of fear. When the VIX is going up, that means that there is a lot of fear. Well, what I did is on this chart, I made the VIX invisible, and then over top of that, I put a 50-period exponential moving average. Typically with the VIX, we use static numbers. When we get down to 12 with the VIX, that means that there's not a lot of fear. When we get to 20 or above, that means that there's a lot of fear. Well, by using this 50-period moving average, we can see that over a period of time, the VIX doesn't stay within those static ranges. It's more dynamic. And there are periods of time when we go up into a higher range, then we drop down to a lower range. After the COVID plunge, we were in a higher range, and we might be in the process now of establishing a lower range as the market has been improving in late, well, pretty much all the way through 2023 and then possibly going into 2024. This is something that we don't use to make decisions. This is just for informational purposes to give us an idea of what is the VIX looking like right now. Then another measurement that we use, and sometimes I'll use this in the daily videos, how fast is the VIX moving? When it's really going up or down quickly, we can put an RSI, which is a momentum oscillator, on top of this to give us an extreme positive or negative reading. Right now, we're just about in the middle and not getting an extreme reading, so I haven't been including this in the videos. Then on top, we look at another type of VIX, and this is called the MOVE Index, where the VIX measures the volatility of stocks. The MOVE Index measures the volatility of bonds. And because the stock and bond markets are very interrelated to each other, that can be kind of helpful for us sometimes. On top is the MOVE Index. Then in the next section is the VIX. And then this red line here is the S&P 500. The green line is the VIX subtracting the MOVE Index to get the spread between the two. Sometimes we can get some information from this. What I mostly look at is on the bottom. This is the correlation. When this is really going down, that means that the MOVE Index and the VIX Index are going in opposite directions right now, where they tend to spend more of their time going in the same direction. Then we look at another ratio of the VIX to MOVE ratio and then calculate that. And when this is really dropping, that just means that stocks are less volatile than bonds. When this is going up, that means that bonds are more volatile than stocks. Then we look at the VIX itself, and then there's another measurement on the VIX called the VVIX, or the VIX of the VIX, and we take a ratio. And this can be helpful for us because when this is declining, that tends to be longer term positive for the market. And this has been declining quite a bit. And so I was showing this in the daily videos, but now that we're kind of sustaining more of a downward move, I haven't been showing this to try to keep a limited number of charts. The daily videos are long enough as it is. So I like to show it in this video as long as we continue to keep going down, and that's positive. Here's another idea that's pretty much the same, a VIX to a 3-month average of the VIX. This is also going down as well, and that's more intermediate term positive. Then we have a thing called the skew index, and we were using this in the daily videos recently. The VIX is calculated around at the money options, where the skew index is calculated using out of the money options. And sometimes we can get some good information from this. When we go up into this red area and then come down, the market is expecting some kind of a big move. Doesn't necessarily tell us the direction, it's just anticipating something big. And recently we did come up into this red area and then we dropped down. At that time, we had been chopping sideways and then we moved up with the S&P 500. So that ended up being an up move. There are other times when we see a high reading and it ends up being a down move after this is registered. Then we look at a longer term version of the equity put call ratio over 5 periods. I typically show the shorter term version in every daily video. This is a longer term look at that same calculation to give us more of a perspective. And we're continuing to come down, and then we were going back up. There may have been some additional hedging going on ahead of the holiday weekend. So we saw a lot of put buying, and that makes the put call ratio go up. We'll see if that adjusts itself as we go into 2024. Then here's the 253 period equity put call ratio. This is very long term, and when this is going down, that tends to be positive for the stock market. I was showing this for a while as we were bouncing around, but now we seem to be sustaining more of a downward move. And then keeping an eye on where are we from the all-time high as of Friday's close. We are down 1.01% for the high that was set in January of 2022. That's over on the left. Over on the right is Friday's close, the last day of 2023. We're wondering, are we going to be able to break above this and set a new all-time high? Is the previous all-time high going to act as resistance? We've already had the NASDAQ 100 and the Dow setting all-time highs. Right now, that has not been confirmed by the S&P. If this does go up and set a new all-time high, that would be a confirmation. Now, the S&P is bigger than the Dow, and there's a lot of the same components in the NASDAQ 100 that are also in the S&P 500. So if we come up and hit this resistance level and start to come down, and then we see weakness in the NASDAQ 100 and Dow, that may signal that we're putting in some kind of a shorter term top and we might be due for a pullback. It's pure speculation, just something to watch for to see if it unfolds that way. Then at stockcharts.com, they have a series of things called technical alerts. These are predefined, and you can go access them. And when something positive happens, it's in green or blue. When something negative happens, it's in red. And this looks at not only stocks, but other indexes throughout the stock market, different sectors. It also looks at different markets like oil. And just to get an idea, we start on on Tuesday, because we were closed on Monday for Christmas, where we had an initial negative signal, and then we read this from the bottom up. And then things turned pretty positive for a while. We had a few red signals generated, but since we had an up week for the week, not a real gangbuster week, but we see a lot more positive signals than negative signals. And we can look at this, and just by looking at a few different alerts that have been triggered, we can get an overall feel for what's happening in the market. Then we also look at 5 main indexes. I focus on the S&P 500. We also keep an eye on the Dow. We keep an eye on the NASDAQ 100. We keep an eye on the mid caps and the small caps. These are also represented by ETFs. And what we can do is we can take ETFs and then rank them on a score of 0 being the lowest up to 100 being the highest and see which index is performing the best right now. Well, after going into third place last week, the QQQs, which is the NASDAQ 100, they're now back in first place, coming in at 88.6. They spent a bit of time well into the 90s, and they were looking pretty strong. This is a large part of the mega caps that have really been responsible for a lot of the upward move that we've seen in 2023. That's kind of pulling back a little bit. That's why we're not seeing as high of a score as we were before. But for right now, the NASDAQ 100, it's just coming off setting multiple all-time highs in the previous week, and it's still looking pretty strong. Then in second place, we're experiencing what's called the January effect. Right about in the middle part of December, we started to see a real improvement with the small caps, and that's represented by the IWM, which is the ETF for the Russell 2000 small cap index. And we were down into the teens if you go back into November. So not very long ago, this was giving a very low technical score, and it's really been improving. Now, we had a down day on Friday, so it's rolling over a bit, But right now, it's the second best performing index that I follow, coming in at 83.6. Then in third place is the Dow at 83.4. In fourth place is the S&P 500 at 68.5. We've been seeing some weakness there. And then in last place are the mid caps at 68.2. We've been seeing some kind of under the surface strength in mid caps, and they can somewhat partake in this January effect, which usually people think about, well, this is a good time to buy small caps. Well, it can also be, if this continues, a beneficial time to buy mid-cap stocks as well, or to follow the indexes. But for right now, that's the weakest of all the indexes. But they're all hanging in there, doing pretty good. They're all above 50, and given another upward move, we would see a real improvement in these scores. Some short-term charts, we look at what I call a rainbow. It's a moving average rainbow going from 10 periods up to 50 periods, and I change the colors around so it looks kind of cool. And I try to look at all of this chart together to get a big picture look in a short-term time frame. And we're above all of the moving averages and going higher, and the moving averages themselves are really starting to unfold and look more like straight lines. You can see back in 2022, we were dancing around all over the place. It was like we were playing in spaghetti, where here it's more moving in the same general direction. Then we also look at a double and triple exponential moving average study. I've been showing the 50 period. This is the 20 period. It's a shorter term, and we have the green line and the blue line here. And we've been following kind of close to this, and we've fallen a little bit below it. So we'll want to keep an eye on that. But if we could get back and recapture this, that would be more positive in the short term. Then we take another look at a 20-period moving average study, both a simple and exponential moving average study. The simple moving average treats all 20 periods the same. So period number 1 and period number 20, they get the same amount of weight in the calculation. Where an exponential moving average, it shifts it so that more recent prices get more in the calculation. They're weighted a little bit different. And there's the debate that goes back and forth, which one is better. I plot them both on here. We have in blue is the exponential moving average. And when that's above the red line, that means we're going up kind of fast. And then the red line, of course, is the simple moving average. And we're well above both of these lines, and we continue to go up. So that's just suggesting that the short-term trend is still up. Then we have a number of short-term oscillators that we look at. And for some reason, this one hasn't been coming up on the list lately. This is the Stochc RSI. It takes a stochastic study and an RSI and tries to put them together. And it's a pretty touchy little indicator. We can get extreme positive or negative and then just stay there for a long time. This is also included with some other shorter term indicators that I go through every day. And right now, we're not giving any kind of an extreme positive or negative reading, so I haven't been showing this in the video. Then another short-term indicator that we look at is called the Commodity Channel Index, or CCI. This is based on 14 periods. We spent some time being extreme positive, and now we're dropping back down into more below that extreme reading, so I haven't been including this chart. And then the same indicator plotted on 20 periods gives us a little bit more of a short to intermediate term look here. That's also declining after being extreme positive. Then intermediate term, we have the same idea behind the rainbow, except these moving averages go from 50 periods up to 100 periods, and we're well above all of the moving averages, and we're starting to see the ribbon itself roll over and turn more positive as the intermediate term is showing strength lately. Then we have another type of moving average, which goes back to the all-time high, and we anchor it to that. So this is an anchored moving average. And then as we were really falling down earlier, we came down and actually broke below this back in October, and then we were able to bounce up off of that. At that time, I was really showing this chart, but when we were able to bounce back up and get further away from it, I stopped showing this chart. Then we have a Connor's RSI, which is very similar to a regular RSI, where we look for extreme positive or negative readings. This one's pretty spastic on a day in and day out basis, but we don't get extreme readings all that often. Right now, we dropped a little bit down below the midpoint, and we're not getting an extreme reading. And then we have a 50-period moving average study, which is the same as the 20, except it's based on 50 periods. And here we see where the exponential moving average is more comfortably above the simple moving average. That suggests that the intermediate term trend is still up, and we're well above both of those, and all of these continue to advance. and a 100 period moving average. Same basic idea, where just recently we saw the exponential cross above the simple moving average and prices above both, suggesting that longer in the intermediate term, we're still in an uptrend. And then we want to know how far above or below are we from the 200-day simple moving average. We're well above it right now, so we are green. And then we have standard deviation. Now, this doesn't measure direction. This measures speed. So when we're dropping down below the moving average and going down, that means that the stock or index or whatever you're measuring is slowing down. When this really starts to pick up, that means it's speeding up. And so we just kind of keep an eye on this to give us the basic speed of something moving. Then this is a McClellan oscillator, and I look at these every day, and these are very influential. I was showing these in the videos as we were extreme positive. Now we're starting to come back down. We had a down day on Friday, but we're still above zero. And anytime we're above zero with the McClellan oscillator, that is a positive day for the summation index. And so those two indicators go well with each other. This tends to be shorter term, where the summation index is more intermediate to long term. And as long as we're above zero, even though we're declining, we still are positive. And then we look at the McClellan oscillator for the NYSE, and that's really the McClellans who developed this back in the 60s. They developed it for the NYSE through some reverse engineering that we've been able to calculate it according to different indexes, including the S&P 500. We're also still above zero, even though we have been declining, but it's still positive. So that means that the summation index for the NYSE continues to be positive. And then we look at the percent B indicator. Bollinger Bands are very popular, and we spend a very short period of time closing either above or below one of the Bollinger Bands. Well, that's what the percent B indicator measures. We did spend about 4 days above the upper Bollinger Band, and that's a pretty extreme reading, and that's a pretty rare event. And so we were waiting for either price to move sideways, price to come down, or the Bollinger Band to continue to go up, and so price could go back inside, or a combination of all those things happening, and that ended up playing out, and so we're no longer extreme with this indicator. And then we have a CMB composite index, which is supposed to be a standalone trading system. I don't use it like that. I use it like an oscillator. We spent pretty much the whole month of November extreme positive. Then we dropped down. Then we spent a large part of December extreme positive. Now we're dropping back down and no longer extreme. The mass index is not generating a signal right now. When we get close to this red dash line and the blue line, that's when we really pay attention to this. And then we're seeing something that's kind of interesting here. This is the S&P 500 on top and the S&P 100, which are the biggest stocks that make up the S&P 500. That's on the bottom. Well, earlier in the year, we were seeing the S&P 100 outperforming the S&P 500, okay? They're bigger companies. These are more in that mega cap type category. And so that wasn't really a surprise, but we still want to make note of that anyway. What we're seeing right now is a little bit of a reverse. And if you watch the intermarket analysis video, I have a study that I go through, and it's really showing some weakness with the S&P 100 compared to the S&P 500. Now, we can take that as negative and say, uh-oh, the 100 stocks are starting to fall apart. Maybe the rest of the market's going to follow. Or we can switch that around positive and say, well, that just means the rest of the stocks in the S&P 500 are now starting to perform better and are outperforming the stocks that had been doing better earlier in the year. So there's a positive and negative slant to that. This is kind of showing that, but not to the same degree, where the S&P 100 has been underperforming the rest of the S&P 500. We want to keep an eye on this. And then this is just some measurement charts where we hit our low in October of 2022, and then we bounced up. We hit a high in July of 2023, and then we fell down. And then in October, we hit another low, and then we've been able to bounce up off of that. And where this black line is here is just how far we've come up since those October lows. And then we look at point and figure charts. This does not take time into consideration. Whether it takes an hour or a year, however much you say, only draw an X or a O if the price moves by a certain amount, that doesn't matter. Well, when we see a series of X's, that means price is going up. When we see a series of O's, that means price is going down. We don't have any new X's or O's that have been drawn recently. And the last signal that was triggered here was a double top breakout that was triggered on November 20th. So that's still on the books for right now, and that's positive. If we put in one more X here, we're going to be coming back to the all-time high again. So that's something that we're kind of watching to see if it will happen or not. And then we look at discretionary versus staples. And there's a number of different ways to measure this. One of the newer ETFs that are out there is an equal weight ETF for both discretionary and staples. Discretionary is more growth, where you want to buy low and sell high. Staples, those are things in the economy like toothpaste and toilet paper, things you have to have no matter what's going on in the economy. Well, when the economy is doing better, discretionary tends to do well. When the economy is under pressure, staples tend to perform better. And then on the bottom, we take a ratio between the two. And this is showing that discretionary had been outperforming the staples sector, but lately we've been seeing some weakness here. So it's still positive, and we still like this, but to see this coming down, we want to see this turn around and go back up for it to turn more positive. And then we look at the S&P 500 is represented by the SPY, and we compare it with 3 to 7 year bonds. When we're up in this area where we're at right now, that means the market is anticipating a soft landing. And we've been doing that. First part of 2023, we were just screaming to the upside. Then we hit the summer months. Then interest rates started to go up. Then we started to have some pressure on stocks. And this really started to come back down. Well, since the October lows, we've been coming back up, and this is showing improvements. And long-term, we also have a long-term rainbow going from 50 periods up to 250 periods, and we're well above all of the moving averages that are plotted here. And the more we stay above this, the more these lines will turn up and look more positive in the long term. Then this is the special K chart. This is a long-term oscillator that we look at. We don't get very many signals from this. We are positive since we're above this red moving average. And so I don't show this because I'd just be showing the same thing day after day after day. And then this is an arithmetic scale. Most of the charts that we look at are log scale. Well, every once in a while you switch around the scale a little bit just because that gives you a bit of a different look. And for a while, we were dealing with this trend line going back to 2009. But since then, we've really started to go back up, and we're far away from the trend line, so I stopped showing this chart. If we do see some sustained weakness and start coming back down, I will start showing this chart again. Kaboom, if you heard that. And on top, there's an S&P 500 weekly chart. In the middle is the weekly chart of the German DAX. That's the biggest stock market in the EU. And right now, they have a pretty strong correlated relationship. If one's going up, the other one's going up. If one's going down, the other one's going down. Now, there are times that they get out of whack with each other, but right now, they are having a strong correlated relationship. And then we look at the U.S. 10-year yield. That's in the U.S., of course. And then we subtract the German 10-year yield. And that gives us a line that we can follow here. And right now, because U.S. rates are higher than German rates, we're above this red line. And then in the middle area, we can plot the U.S. dollar index. And sometimes we can look at the correlation between the two, and it can get pretty high. And so if this is going up or down, then the dollar will have a tendency to go up or down. But right now, that relationship is really dropping off and getting back down more to a neutral area. So this chart just isn't all that helpful right now. Then we look at some support and resistance areas. This is measured from the COVID low to the all-time high, and then each one of these areas are separated into 25% chunks. And as we were going through all of this, sometimes this provided support, sometimes it provided resistance. Now that we're coming all the way back up here, I stopped showing this chart. We're in what we call no man's land. And then we use Fibonacci retracement levels. Also, until we come back up to the all-time high, we're kind of in no man's land here right now. And this is another Fibonacci chart, also in no man's land. And then the NASDAQ is continuing to be in no man's land. And you can tell that it's quite a ways away from its all-time high. We have the NASDAQ 100 setting all-time highs in the past week, but the NASDAQ composite itself is not there yet. And then this is an indicator that I developed decades ago based on a strategy. And I don't do the strategy anymore, but I kept the indicator. Very simply, this is a 20-period simple moving average of the open, high, low, and close. And that plots this little mini rainbow here. And when we're going up and prices above that, that's more positive. Now, if we start to see some kind of a decline here, sometimes one of these lines may end up providing support. If we are going down and then we bounce back up, sometimes one of these lines will provide overhead resistance. Right now, everything is still looking quite positive. Then we have the Ichimoku cloud, another study in support and resistance. We are above both the red cloud and the green cloud. We're far away from it. If we start to fall, that's when I'll be showing this chart again to see, is some part of this cloud going to end up providing support? And really all this are some moving averages that are shifted forward, but a lot of people really rely on this. And then here's another Fibonacci study. This is the NASDAQ 100. You see where we have exceeded the previous all-time high, but we have now come back down below that. Is this going to present a problem here, or are we going to get some more strength and be able to break on through to the other side, as Jim Morrison would say? And then here's the financial sector. When we were running into trouble, we were coming down and we were hitting this support level. Right now, the financial sector is doing quite well and is in an uptrend. So I haven't been showing this chart since we're far away from this line. And then this is a daily trend line study. Man, I was really relying on this heavily for a while, but now we've broken well above all of these trend lines that we've been following. So I'm like, okay, why show the chart right now? And then some broad market measures. The Vixen is like the VIX, but the Vixen applies to the NASDAQ 100. And I don't use this middle area because it looks like icicles falling off a cliff. I use more of the line study down below, but then I really rely on the VIX more than I do this, but still this can be helpful. And then we look at tips, which when we're in a rising interest rate environment or a rising inflationary environment, people get into tips. These are Treasury inflation protected securities. Now, when inflation tops out, when interest rates top out and they start to come down, that's when folks start shifting out of tips and getting into bonds, longer term bonds. And when this ratio is going down like it is now, that means we're seeing that inflationary worries are going away as this ratio has been coming down. And then we take a ratio between the QQQs, which is the NASDAQ 100, and the Dow, and they have a pretty strong correlated relationship with each other. The bank ETF has been showing a lot of improvement. We really took a dive last March and then spent a lot of time going sideways. Now we've seen a bit of a bounce out of this, enough to generate a golden cross. We've been going sideways lately, but we have been seeing some improvement with the bank ETF. And then we look at the regional banking ETF, and it's actually generating a golden cross when we compare it to the financial sector. So the financial sector has been showing improvement, and the regional banking ETF inside the financial sector is also showing some improvement now, after it had been weak for most of 2023. Some rate of change charts, I use these just for information. This plots last Friday's close, the last trading day of the year, and then goes back 250 trading periods before that. And when this is going up, we tend to be positive. I have that same chart here going back to 1980. When this is going up, we tend to be more positive. Keeping an eye on bonds, where we do a study between the S&P 500, which is in red, and then the long-term bond ETF. That's the 30-year bond. And we look at the relationship between the two based on 50 periods. That's a longer-term look. And when it's getting a high reading like it is now, it means that longer-term bonds and stocks are tending to go in the same direction. Then we can look at the shorter-term relationship based on 10 periods. That is not as strong as it has been. A lot of times it will get stronger than what we're seeing right now. Then down on the bottom are a couple of different ways to measure the spread between the two. And then we look at the correlation between the Qs and the long-term bonds, and they're having a pretty strong tendency to go in the same direction. So if the NASDAQ 100 is going up, chances are the price of bonds are also going up as well, longer term. Here's the yield curve. We still remain inverted with the 10 to the 2-year and the 10 to the 3-month. In fact, if you can see this, we're starting to go back down again. We're becoming more inverted. The idea is that when we are inverted and then go back above, whether it's the 10 to the 2 or the 10 to the 3-month, that usually starts the countdown to see, okay, are we going to head into a recession? Well, we get looking a little bit better as interest rates are going up last fall. Now that interest rates are going down, we're seeing the yield curve actually start to decline as well. Then we look at the shorter term bonds based on 1 to 3 years and compare it with 3 to 7-year bonds a little further out. When this is going down, that means that maybe the Fed is done raising rates. And that's kind of what the market is anticipating. Now, earlier in 2023, this was really starting to come down. And that's when I created this chart. It looked like we were getting done at that point for interest rates to keep going up. But then everything shifted over the summer and we saw this ratio starting to go back up and stocks really became under pressure. Well, now this is starting to come back down again, suggesting that maybe the Fed is in fact done raising rates. And then this is an inverse of that same chart. When we were coming down, that means interest rates are going up. Now that this is going back up, that means interest rates are going back down. And then we look at cash based on the 1 to 3 month T-bill and compare it with further out bonds. When this is going down too, that's more friendly for the inflationary environment. Then I have a lot of different charts for the possible positive scenarios. I've been using a lot of them in the daily videos. This is a measurement of the percent of stocks in the S&P 500 that are above their 200-day simple moving average. And when we're above the midpoint and going up, that's positive. Well, we can also use this like an oscillator. When we get an extreme positive or negative reading, we're not seeing that now, so I haven't been including this chart. But we're seeing this in some other studies based on 50 periods with the mid caps, small caps, and the S&P 500. They're getting extreme positive. That's why I've been including those charts. So thank you. I hope you found this helpful. I hope you have a really, really good 2024. Please feel free to check out some of the other videos that I post. Have a really good holiday and a really good start to your week, and I will talk to you in the next video.